We're here with Eric Eckhart, former CEO of Purple Bricks US, and we're continuing the conversation that we started in the last edition of Insight, where we talked to Hauser about the discount brokerage model. And as we profiled in the article, we covered this pretty in depth at T360 in the 2018 Swanepoel Trends Report. We profiled 9 discount brokerages. And of those 9, only 3 are still around. And given that Purple Bricks was kind of in a one of the poster childs of the ones that failed pretty spectacularly and entered the US. It's a UK company, entered the US in 2017 and then shut down US operations in 2019. And Eric was the CEO for the run in US. And he reached out to me after that article and was like, hey, here's some things that I think you should know about it. And I thought it'd be a great person to talk to about what's up with the discount brokerage model, why hasn't it really caught on, and some of what actually happened from the inside with Brokerage. So Eric, thank you for being here. Excited to talk to you about your experience there and your view on the model that we'll talk about today. So.
Yeah, no, Paul, I appreciate that. And I'll answer there's 2 questions there. One is kind of what happened.
I'll ask them brief. I just want to introduce you, say hi, and then I'll go and ask you a really direct question here. So in your history a little bit, so before you came to Purple Bricks, and I think you officially started in 2016, a little bit
Correct.
Before the debut in the US, and you were at Hubsu, which was kind of an online auction real estate kind of model or firm, and you were the general manager of that. And then since then you've worked with Real, which is a kind of a newer brokerage model. It's kind of a digital model for brokerage, and now you have some stealth projects you're working on. So before we talk about Purple Bricks and ask my questions, I think it'd be good to set up what was the model, or describe the model Purple Bricks had in the US.
Yeah, no, thanks, Paul. Just to summarize it, we really competed on offering great value and service at Purple Bricks at the time we were here in the US. So we looked at the landscape as very crowded at the time, not a lot of optionality, meaning from a consumer perspective on various fee structures, service offerings. So what we wanted to do was come in and offer that great value and great service. So our motto was cloud-based brokerage operations, which is table stakes today, meaning we had a very lean operating model. We could pass cost savings on to the consumer. Our agents were 1099 independent contractors. And as a result, we set up a structure and a system where they could focus most of their time on servicing the consumer versus focusing on their next deal.
And the way it worked with consumers, right, is they would pay an upfront fee to engage Purple Bricks, and you targeted sellers primarily, and then we're trying to work backwards into the buyers. And the sellers would pay your upfront fee. Is that correct? And then,
or they could pay at closing, which 9 out of 10 folks preferred to pay at. There was some incentive, but usually they would pay at closing, so they didn't have to pay until successful sale on their property. And we still offered a quote unquote market comparable buy side commission, which we empowered the consumer to decide what that fee level should be.
So
2%,
it was about
$3,000
flat fee, roughly around that.
Depending on the market, correct. Yeah. So we started out kind of an entry level for early adopters, and we started to increase that accordingly as we expanded across the US. But it fluctuated depending on the market, average sale price, homes, etc.
Yeah, you all had big expansion plans. You spread across the US pretty quickly. You started in California, then went to the East Coast and Arizona and Las Vegas and a lot of places. So so you mentioned in the email that you think it was an issue primarily of why Purple Bricks flamed out in the US was the customer acquisition cost and the strategy there. What do you think was the challenge there, or the miss with the structure of the rollout?
Yeah. So, from a performance perspective, we exceeded industry averages. We have data to support that. If you look across Purple Bricks at the time, we were in Canada, We're in obviously the UK, the primary market where it originated from, Australia and Germany. And we had one of the best performing metrics across the board. Really where, quite frankly, could have been more efficient and been more optimal was around marketing spend. That's where the inefficiency was, specifically around customer acquisition. And the reason for that was because our model, the playbook we used, which was successful in other markets, was we're going to build a lot of brand awareness considerations. To do that, it's very expensive. So using traditional mediums like television, radio, and other mediums that are what we call above the line advertising to build that awareness consideration. And we knew that going into the market, that it would take us about 1.5 years to break even. So any new market, our customer acquisition costs are X. And then over time, they drop down accordingly. What happened in the US is that the more we spent, we ultimately hit a point of diminishing returns. We just plateaued. So as a result of that, we started to shift our spend more towards digital. But that was a playbook we used with success. I say we, my peers in the other markets in the UK, and we brought that to the US. So by the time we shifted that, to the levels that we wanted. Again, we're forecasting a modest loss in the last year, but
we know that it's like building a real estate brand is very expensive in the US, as we know. Like Zillow and Redfin and all these folks are spending hundreds of millions or have spent hundreds of $millions a year. Okay, so the customer acquisition cost, it struggles. So if you were rolling with what you know now, what would you have done if you feel like you could have, if you were making all the decisions about the rollout from the very, very top of like decisions of spend and strategy? How do you think you would have, because you mentioned that you found some success if you look at the actual model in the area, but how would you have done it? How do you think you would have found success if you could have called all the shots, knowing what you know in retrospect?
Yeah, so essentially asking for a retrospective. So there's some learnings from the model that we had. I think number one is obviously have more below the line advertising, more direct digital customer acquisition. Again, this is based on the market trends at that time. So it would have been more of a mixed, more weighted towards digital customer acquisition, I think is one. I think number two is from an agent perspective, our agents were primary mandate, which all agents are, as trusted advisors. They're center of the transaction, important to everything that we did was to service the consumer. I would balance that more out towards a hybrid offering, where not only are they servicing the consumer, but they're also monetizing relationships and other business opportunities that they have. Our agents did not do that. They just focus exclusively on the consumer, and we generated the lead flow. I think those are the two biggest things.
You mean the ancillary, like title and mortgage? And
no, not even. Title and mortgage, we did very well. So for example, we stood up title almost within the first 12 months and escrow closing services. We had near 80% capture rates.
Yeah.
So we had, and then these are independent contractors too. This isn't W-2. So we had a very lean operating model. So it worked very well.
Before we finish the other thought, what was the success? Like, how did you achieve such high capture rates there, especially with your independent contractor agents? Because that's a challenge that I know a lot of brokerages are trying to solve for.
Yeah, not to oversimplify, we delivered on our promise, and we built a platform and system for very efficient and transparent pricing for customer acquisition. So the agents that worked with us, our promise to the agents was we have to deliver value, and two, we have to deliver a service that's at least at parity or better than the other third-party vendors that are out there, being some of the top, say the top 5 closing or title companies out there. And we made sure we delivered on that. And as a result of that, our agents and the culture we had, they supported the products and services. Obviously, the consumer had a choice from a RESPA perspective. Everything was compliant, affiliated company disclosure. We checked all the boxes off. But at the end of the day, the consumer made that decision. And based on the execution that we had really good capture rates versus where the market's at.
Mm. So getting back to the original question to answer the point, you mentioned that you would have gone after some of these other, not just the consumer. Well, what you were clarifying what you meant there as far as targeting other revenue sources.
So what I meant by that statement there, just for clarity, is that the agents we had, their sole responsibility was to deliver great value and service. They did not have to source new business opportunities. We provided 100% of the lead generation opportunities. I would have balanced that out more towards a hybrid offer and saying, we have a wealth of lead gen through our marketing spend and other relationships. Although at the same time, we still want to be proactive, not reactive, and go out to the market and source other opportunities. That's what I meant by that. With regard to other revenue sources, we did have the affiliated services stood up too. So we already had that in play.
Got it. So, going back to the kind of overall gist of why we're kind of even pulling, or we're pulling a thread on what's up with what's happening with discount brokerage, the discount brokerage model now. Like Redfin's the one extent, one that's kind of still going, and it's had its ups and downs. It's still it's achieved some profitability at times, and then it struggles. And of course, it jumped into iBuying, and now it's backed out like a lot of other companies. Why don't you think the discount brokerage model has really taken on in the U.S.?
Yeah, I mean, that's a great question. I think there's a few consistent themes on why they hasn't scaled or acquired, they have more of a market presence than what's out there today. I think one is just high OpEx. So as I mentioned earlier, our agents were 1099. There's still several models out there today that have W-2. There's a few that are doing it very well, quite frankly. But for the most part, the ones that were in market, that's a higher fixed operating cost given the unit economics, the revenue, the receive average revenue per closing. I think that's one. I think two, as I mentioned, as we just spent some time on, is around customer acquisition costs. No one's really solved for very efficient marketing spend, at least that I've seen, for the quote unquote traditional model, which is through the agent for customer acquisition. So to have to spend and build that brand awareness and consideration is very expensive. I think three is, quite frankly, competing on value is not enough in today's market. The reality is everyone's doing it. 10 years ago was disruptive. It was different. The reality is if you're at, I shouldn't mention names, but I will, call a bank, your EXP, XYZ firm. If you're in a living room, you have autonomy to discount your fee accordingly to secure that listing. And that's being done in practice today. Where 10 years ago, you're going through objection handling techniques, training, skills on how to maintain that high level of commission. And you'd have to get sign off. There was layers there. So it's being done already. So you have to compete more on just value alone to be successful.
So I think, and you bring up the point about the customer acquisition cost, and I think it's drilling down a little bit into it, because with the discount model, the company kind of has to form the relationship, because the agent, if they were getting the business in a traditional model, they would earn so much more of the commission. So the company has to earn the business, own the consumer kind of, and then filter down through the agent. And I know you all kind of grapple with that. Like right before Purplebricks ended up leaving the U.S., you all had tried or like implemented at the last minute, I think, a employee model, maybe potentially to.
We never implemented an employee model at Purplebricks. It was always 1099. At least during my time.
Did you announce it? Like, okay.
No. We never implemented. Again, our 1099 agents were performing.
I'll have to go back and double check the news story, because
I can tell you we never did that during my tenure. So there was never W-2. And just to put things in perspective, our 1099 agents, their net promoter scores were comparable to eBay, Amazon. We had high capture rates near 80%. We had X thousands of 5-star on average, near 5-star reviews. So they were delivering on every performance metric in the market as a 1099 agent. So we didn't have to go to W-2. If you go back and look at the market, you go back to Zip Realty, W-2. I mean, there's so many case studies out there about just how that depletes and burns cash flow with the W-2 model.
Yeah, I believe you're right. I just double checked. I looked at the story I was referencing.
There's been a lot of information since the Purplebricks days that's been third party. So again, share it with me. Maybe it was after I. No.
I just double checked. I was misremembering exactly what it was. You made some shifts, but it wasn't that one.
And definitely not around the employee independent agent contractor model. And just to step back a little bit, once again, if you don't mind. So, part of the reason, the driving force of exiting the U.S., as I mentioned before, it was a conscious decision made by the board with regard to capital allocation. So they pulled out of Australia, the UK, Canada, and ultimately the joint venture in Germany. When we were operating here in the U.S. market. So the day I resigned was the same day the UK CEO resigned, the Australian CEO resigned a month prior, and then so forth.
Yeah, and the company was really, like, before, as it was expanding to other countries from the UK, it was like really on fire, and now it's like still grappling. I mean, I just looked at the latest financials. It's like net losses still. So it's still alive and kicking in the UK, and it's trying to solve for some foundational structure of its model. So it's still going, but it's definitely, it looks like it's struggling. So we were talking about the reason why you think that the discount model is struggling. I think would you put top of the list would be the customer acquisition costs and the ability to because that's where the discount lies essentially. Because otherwise, agents, if they're winning the business, they're like, well, I might as well take 2.5% of the commission.
Yeah, I mean, I can speak from my experience and what I've seen in the market. At least for us, it was really came down to efficient marketing spend. If you went through our P&L, that was the item that stood out was our marketing spend with regard to the structure of our model. That would be I would probably rank that up there. At the same time, we had a very lean operating model. Again, the performance metrics were strong. The agents were still center of the transaction. They were still providing a full service offering. I think we did a really good job in providing optionality with regard to educating the consumer that, yes, you are paying a discounted fee, but you're getting a full service offering as you would with any other firm in the marketplace. So,
but you mentioned that people are competing on value now. It's like, I don't hear that much a part of the conversation of like, that's even that much of a driver for a lot of consumers. And I'm not privy to the latest consumer research around that and like the surveying, but I don't get the sense that, and like for example, Redfin just dropped its buyer rebate, and that has, because they say it doesn't really move the needle. So it's not really something that, of course, on the buy side, it's always a little bit tricky because buyers aren't necessarily aware of how they're paying their agent or it's a direct relationship there. But it's even on the list side, like it doesn't seem like it's part of it, but it's not like a key driver seems like for a lot I mean, what was your experience when you were
so yes and no. I guess it depends.
Yeah.
So I don't know any consumer home seller that's excited about paying 5, 6, or 7% to sell their home if they can get a comparable or better offering at a lower cost. That's based on the data market research we did, consumer focus groups. I think to your point where I agree, consumers aren't as aware and informed. At the end of the day, I think there's still that misconception in the marketplace that if you pay a lower fee, you're going to get a lower service offering. And in fairness to the market, there are firms out there that are still offering that. You pay a flat fee or a lower fee, you have access to the MLS. It's a la carte. There's friction involved in the model where, in our experience, at least the markets we were in, the consumer spoke. And there was no denying that there was a demand for a viable alternative in the market where, I believe we should still be in the market today. There's decisions that were made.
That'd be a great study, and maybe I'm sure it's already been done. And like you mentioned, some research that you all done, and maybe at source, but like this is brought up over and over again. Such an infrequent, high-priced item that people are buying that sometimes they're like, okay, if I'm going to invest, I'm going to get the best and get white glove and get not only white glove, but like get somebody I trust and like is there and have calls. And it's often that type of service is more expensive because it's very high touch and very involved. I think we covered what I was hoping to talk about today. Thank you for taking the time. Is there anything else you'd like to add on the topic that we maybe didn't touch?
No, I think we hit some of the general key themes around customer acquisition costs, higher OpEx. One thing we didn't add is, if you look at some of the models historically, I think some of the leadership didn't have enough weight, quite frankly, towards on the real estate sector experience versus more tech and having the right balance.
Yeah, it's tricky.
I can say, I think I'd leave one takeaway that I still believe there's strong demand for the right model and the right execution. I know there's still only a handful of folks that are still competing in this category. And there's, I think there's some leaders that will surface and be more prevalent as time goes on. But I also believe that some of the incumbents that are in the market today are stronger than ever. They have an established brand equity, agent base. And I think it would be naive to think that there will not be continued pressure on commission fees going forward, especially with some of the regulation some of the pending litigation out there in the marketplace that could potentially change the market overnight. So I think everyone just needs to be aware there's room for everyone. And I think one thing we'll all agree on is that the agent will continue to be the center of the transaction.